If I told you the US dollar could be both the strongest currency on Earth and dangerously exposed at the same time, would you stay with me for 7 minutes to see how that can be true? Good, because the answer to "is the dollar collapsing in 2025" isn't a yes or no. It's a map with 3 roads. One you recognize, one you're underestimating, and one you really don't see coming. Start by resetting what collapse means. Collapse is sudden loss of function. Buyers vanish, credit dries up, prices whip, trade stalls. What we're actually living through is slower and more strategic, a contested dominance. The dollar is still the default language of global money, but more countries are quietly choosing bilingual, keeping dollars while transacting in alternatives when it suits them. That choice, multiplied across energy, commodities, and cross-border settlement, is not fireworks. It's erosion you only notice when the cliff edge is closer than you think. Here's the first truth you need. The dollar's power is not just about charts or headlines. It's about systems. The dollar is embedded everywhere. Contracts, invoices, balance sheets, shipping insurance, commodity clearing, derivatives collateral, and the plumbing behind bank transfers. Pull one lever, say a country decides to invoice oil in something else, and the rest of the machine doesn't instantly reconfigure. Friction slows change, but frictions don't stop change. They price it. And right now, those frictions are shrinking. Now zoom in to the pressure points. Debt is the most obvious one, but not for the reason you think. It's not just the size, it's the trajectory plus interest costs. When funding a large deficit meets higher rates, the interest bill competes with everything else. Investors don't panic because the number is big, they hesitate because the path is unconvincing. Confidence is about credible forward motion. Without it, buyers still show up, but they demand a higher price. That higher price echoes through mortgage costs, corporate borrowing, and global appetite for treasuries. The dollar doesn't collapse there, but it stops coasting. Sanctions are the second pressure point. Weaponizing access to the dollar system has consequences. In the short run, it reinforces the dollar's gatekeeper status. In the long run, it incentivizes parallel lanes, new payment rails, bilateral currency swaps, and commodity deals settled outside the dollar. Again, not fireworks, just more transactions bypassing the old route. 10 bypasses are trivial, 10,000 are trend. Energy is the third pressure point. For decades, the petrodollar locked oil into dollars. Today, energy producers and large buyers experiment. Some trades in yuan, some in euros, some in local pairs. It's not a wholesale replacement, it's portfolio hedging. If oil flows in several currencies, global demand for dollars dilutes at the margin. Margins matter when compounded across trillions. Digital settlement is the fourth pressure point. Central bank digital currencies and instant cross-border networks are cutting time, cost, and friction. If two countries can settle trade directly with programmable compliance and smart collateral, who needs an intermediary currency for every transaction? You still need dollars for depth, liquidity, and safety in storms, but you need them less for everyday weather. That shift is subtle and huge. So, is the dollar collapsing in 2025? No, but the dollar's monopoly is becoming a duopoly or even a multiplex. And multipolar money changes the rules you use to judge risk, return, and protection. Here's the frame that actually helps you make decisions. 3 scenarios that you can track in real time. Scenario 1, hard break. This is the nightmare people imagine. A failed treasury auction, a policy shock that shatters confidence, or a geopolitical event that freezes dollar funding. In a hard break, dollars spike first because everyone runs to safety. Then, liquidity fractures where leverage is highest. You would see basis spreads blow out, collateral calls, and forced selling. That's collapse energy. It's unlikely, but not impossible. The tell isn't political noise, it's mechanical stress. funding markets that stop clearing smoothly. Scenario 2, soft slide. This is the most plausible path. The U.S. funds higher deficits at higher rates, growth slows, then stabilizes, inflation cools but sticks above perfect, other currencies gain share in invoicing and settlement. Dollar strength becomes episodic, powerful in crises, less dominant in normal times. Think tide, not wall. Your signal here is simple. More non-dollar trade links, more local currency credit lines, more commodity contracts priced in a mix. The dollar remains the anchor in storms, but everyday ships choose alternate lanes when seas are calm. Scenario 3, re-anchoring. The U.S. regains credibility through a mix of real growth, fiscal stabilization, and financial innovation. Dollar plumbing modernizes, instant settlement, better collateral frameworks, transparent offshore dollar liquidity. The dollar's share doesn't necessarily rise, but it stops falling, and spreads remain tight. In this world, the dollar isn't the only game. It's the best game when risk is real. Your tell is not speeches. It's sustained investment flows, steady auctions, and fewer headlines about workarounds.
Which scenario wins? Paradoxically, the dollar's greatest vulnerability is also its greatest strength. It's everywhere. When stress hits, you need dollars precisely because they're embedded in the world's obligations. That's the dollar smile. Weak in middling growth, strong in global stress. If 2025 delivers choppy geopolitics and uneven data, expect the smile to reappear. That's not collapse. That's a reflex wired into the system. But there's a twist you can't ignore. The next phase of dollar power will be decided less by foreign policy theatrics and more by practical credibility. Can the U.S. align growth, inflation, and funding in a way that feels durable? People don't demand perfection, they demand plausibility. When policy signals feel coherent, risk premia compress. When they feel improvisational, risk premia widen. The dollar responds to those premia faster than narratives do. What does this mean for you? It means the stories that go viral, BRICS launches a reserve currency tomorrow, or America defaults next week, are emotionally satisfying, but financially misleading. The real risk isn't a switch flipping, it's cumulative drift. A tiny change in who invoices what, who funds whom, and who ensures which shipment adds up. 1,000 microscopic choices become macro reality. That's why serious players obsess over plumbing, not slogans. Let's make it tangible. Imagine a cargo ship leaving the Gulf loaded with crude. 10 years ago, that cargo is invoiced in dollars, insured in dollars, hedged in dollars, financed by a bank whose dollar funding is unquestioned. In 2025, the invoice might be split, part dollars, part local currency. Insurance could be cleared through a regional pool. Hedging might run through a domestic exchange. Financing could be supported by a bilateral swap line. The ship still sails, the world still turns, but the dollar's total touch per barrel falls. Multiplied by millions of barrels, years of voyages, layers of derivatives, and the dollar's edge softly narrows. Not collapse, contraction. So, where does the real danger live? In complacency. If the U.S. treats credibility like a permanent asset rather than a renewable resource, drift accelerates. Credibility is earned in boring ways: steady auctions, transparent data, coherent budgets, competent execution. Those bore people. They also anchor currencies. Here's the part most commentaries skip. Alternatives have constraints too. The yuan offers speed and state capacity, but capital controls and governance opacity cap global trust. The euro offers institutional robustness, but political fragmentation and uneven growth limit risk-taking. Digital assets offer programmability and neutrality, but volatility and regulatory uncertainty restrict institutional adoption. Every competitor wins specific lanes and loses others. That's why multipolarity is the destination. No single uncontested king, just several strong houses, each ruling particular roads. So, if you're scanning 2025 for signs of a dollar collapse, you'll miss the plot. Scan instead for micro shifts that add up. More trade settled outside the dollar. More banks building direct rails between regional currencies. More commodity players pricing flexibly. More central banks running pilots that make cross-border transfers instant and cheap. These are not front-page stories. They're footnotes that rewrite the book. Here's your mental model for the year. In crises, dollar demand spikes because leverage is dollar denominated. In calm periods, dollar share slowly bleeds because optionality expands. The net outcome isn't collapse. It's a staircase. Up hard in stress, down softer in normal days. Your job is to see the staircase, not the steps. Now, let me leave you with the single sentence that will change how you see this. The dollar's fate is not decided by the loudest headline, but by the quietest settlement. If the quiet settlement still prefers dollars when risk matters, the dollar lives at the center. If the quiet settlement prefers alternatives when risk is low, the ring, the center, grows a ring of rivals. That ring doesn't dethrone the dollar, it reshapes the throne. So no, the US dollar is not collapsing in 2025. It's negotiating its power every day in every invoice and every transfer against a world that has more ways to move money than ever before. The winner will be the system that offers trust when it counts, speed when it helps, and clarity when it's needed. If you've stayed to the end, you don't just have an answer, you have a lens. And with the right lens, you won't get whiplash from the next headline. You'll see the structure underneath it.